Listen up, because this is important. Candlestick patterns are like road signs for traders. They give you clues about where the market might be headed. By understanding these patterns, you gain a valuable edge in the exciting world of trading. Whether you're a seasoned pro or just starting out, candlestick patterns are an essential tool in your trading arsenal. Imagine trying to navigate a city without street signs. Chaos, right? That's what trading without candlestick analysis is like. These patterns provide structure and insights, helping you make informed decisions in the ever-changing market landscape. From bullish hammers to bearish shooting stars, each pattern tells a story about the battle between buyers and sellers. By learning to read these stories, you can anticipate market movements and trade with greater confidence. Remember, knowledge is power, and understanding candlestick patterns empowers you to navigate the markets like a pro. So buckle up and get ready to dive into the fascinating world of candlestick charting. It's time to unlock the secrets hidden within these powerful patterns and take your trading to the next level. Before we jump into specific patterns, let's break down the anatomy of a candlestick. Each candlestick represents a specific time frame. It could be a minute, an hour, a day, or even a week. Think of a candlestick like a little soldier with a head and two legs. The body of the candlestick is the thick part in the middle. It tells you the opening and closing prices for that time frame. Now, the wicks or shadows are the thin lines sticking out above and below the body. These show you the highest and lowest prices reached during that period. A green or white candlestick means the price closed higher than it opened. The bulls were in control. A red or black candlestick means the price closed lower than it opened. The bears were running the show. Understanding this simple anatomy is key to deciphering the messages hidden within candlestick patterns. It's like learning the alphabet before you can read a book. So pay close attention, because things are about to get exciting. Let's talk about the hammer, a bullish reversal pattern that gets traders excited. Picture this: the market has been in a downtrend, and then bam, you see a candlestick with a small body at the top and a long lower wick. That's a hammer. The long lower wick tells us that sellers pushed the price down, but buyers stepped in with force, driving the price back up near its opening. It's like the market is testing the waters for support and finding it. Now, don't go buying every time you see a hammer. Look for confirmation. A strong green candlestick following the hammer. That's a bullish sign. Remember, context is key. A hammer at the bottom of a downtrend is more significant than one in the middle of an uptrend. It's all about reading the signs and making smart trading decisions. The Doji, a mysterious character in the world of candlestick patterns. This little guy looks like a plus sign or a cross, with the opening and closing prices very close together or even equal. What's the Doji telling us? Indecision. Buyers and sellers are locked in a stalemate, unsure of which direction to take the market. It's like a calm before the storm. Now, there are different types of dojis: dragonfly, gravestone, long-legged, each with its own subtle message. But the key takeaway is this: when you see a doji, pay close attention. The market is at a turning point and a big move could be coming. Which way will it go? Look for confirmation from other indicators and the overall market trend to make your move. Section 5. The shooting star. A bearish warning in the stars. Beware the shooting star. A bearish reversal pattern that can signal a change in the market's mood. Imagine this: the market has been rallying higher and then, whoosh! A shooting star streaks across the chart, leaving a trail of uncertainty. This candlestick has a small body at the bottom and a long upper wick. It tells us buyers pushed the price up, but sellers quickly took control, driving the price back down near its opening. Just like with a hammer, confirmation is crucial. Look for a red candlestick following the shooting star. That's a bearish sign. Remember, context is everything. A shooting star at the top of an uptrend is more significant than one in a downtrend. Use your trading instincts and other indicators to confirm your observations. Section 6. Context is key. Analyzing patterns with historical data. Now, here's the thing about candlestick patterns: they're not foolproof. You can't just blindly buy every hammer or sell every shooting star. You need to consider the context, and that's where historical data comes in. Look back at the previous 10 trading sessions or more. What's the overall trend? Are there any support or resistance levels nearby? For a strong support level is a much more bullish signal than one in the middle of nowhere. Why? Because it suggests buyers are defending that level and pushing the price back up. Remember, trading is like solving a puzzle. Candlestick patterns are just one piece. Use historical data, technical indicators, and your own market knowledge to put all the pieces together and make informed trading decisions. Section 7. Candlestick Patterns throughout the trading day. Candlestick patterns aren't just for daily charts. You can use them on any time frame, minutes, hours, weeks, you name it. Think of it like this. A hammer on a 5-minute chart might signal a short-term bounce, while a hammer on a daily chart could indicate a longer-term reversal. The key is to adjust your expectations based on the time frame you're trading. Remember, the shorter the time frame, the more noise you'll see in the market. So it's important to filter out the false signals and focus on the patterns that align with the overall trend and your trading strategy. Section 8. Mastering Candlesticks, a journey, not a destination. Listen, learning to read candlestick patterns is like learning a new language. It takes time, practice, and a willingness to make mistakes along the way. Don't get discouraged if you don't become a candlestick master overnight. Start by focusing on the most common patterns: hammer, doji, shooting star. Practice identifying them on historical charts and then move on to live trading. Keep a trading journal. Write down your observations, your trades, and the results. This will help you identify what works for you and what doesn't. Remember, the more you practice, the better you'll become at reading the language of candlesticks. It's a journey, not a destination. Section 9. Final thoughts. Chart your course to success. Candlestick patterns are powerful tools, but they're just one piece of the trading puzzle. Use them in conjunction with other indicators, your own market knowledge, and a solid risk management strategy. Remember, trading is a marathon, not a sprint. Be patient, be disciplined, and never stop learning. So, go out there, study those charts, and chart your course to trading success. And remember, the best way to learn is to do. Get out there and start trading.